The stock market has been throwing a really bad tantrum lately, with S&P 500 correcting almost 5% and Nasdaq correcting more than 13% from its all-time high back in November last year. Now people are wondering, is it the beginning of an even larger correction that might lead us to a prolonged bear market? Or is it just something temporary? Well, first, let's look at some of the catalysts to understand why the market is reacting this way. The number one catalyst is, of course, the Fed planning 3 rate hikes this year, with the first one already in March. So we could end up with an interest rate of 0.9% by the fourth quarter of 2022. Now, if you have watched my previous video about how bond yield can affect the stock market, you'd know that a rising interest rate is bad for the growth stock and the cryptos. Because growth stocks usually have a higher debt-to-equity ratio. With a higher interest rate, the cost to service the debt is also getting higher. And their future earnings will also get a higher discount rate, meaning the profit earned in the future is getting less valuable for the current. So their stock valuation will come down dramatically. And cryptos are considered as risk-on assets, which will underperform in a high interest rate environment. Now, both growth stock and cryptos have been the major outperformers since March 2020, the Corona dump, thanks to the money printing and a 0% interest rate. But now, with the fear of rate hikes, growth stocks and cryptos are leading the sell-off. For example, Square, down 50% since the end of October. Matterport, down 61% since the beginning of December. Unity Software, down 45% since mid-November. Ethereum, down 40% since the beginning of November. Most growth stocks are in the Nasdaq index. That is why Nasdaq is down substantially more than S&P 500. And I think we could potentially see more downside to growth stocks and cryptos for the coming weeks and maybe a prolonged consolidation afterwards for a couple of months or so. I will circle back to this point a little bit later. Now, other than the growth stock, a rising interest rate is actually good for the overall stock market, especially for the stocks with lots of cash buffers like Apple, Amazon, Google, Microsoft, and Meta, previously known as Facebook. And these 5 stocks make up 20% of the S&P 500. With a rising interest rate, the bond investors will sell their current bond with lower interest and buy those safer stocks instead. The bond market and stock market are 2 big rivals that compete for the same money. So if one goes down, the other one goes up. And if we look at the historic data of the Fed fund rate, when Fed raises interest rate, for example, from July 2004 to July 2007, Fed was continuously raising the interest rate, and it stayed as high as 5.25%. At the same period, the S&P 500 rose 46%. And if we look at another period, from January 2016 to July 2019, Fed was also raising interest rate to 2.42%, while at the same time, S&P rose 67%. Although we had a big market correction of 20% at the end of 2018, but that was not due to the rising interest rate. I will come back to this in just a minute. So, a rising interest rate is actually very good for the overall stock market. But then what is it that is causing the market panic selling? And I just want to point out that leading into the rate hikes, the stock market tend to correct first. Like you see during March 2014 to June 2014, the S&P 500 corrected 8%. And during October 2015 to January 2016, S&P 500 corrected 14%. Now, do I think that is the reason for the correction we see now? A tantrum in the market? Well, no. I think the ultimate reason is the Fed balance sheet. Look here. The Fed balance sheet has been expanding through quantitative easing. The QE1, QE2, QE3, QE infinity. Quantitative easing is basically money printing. And you'll notice here, during the period of January 2018 to September 2019, the Fed balance sheet had shrunk from $4.4 trillion to $3.8 trillion. So $600 billion, poof, gone. And that was a 13.6% drop in the balance sheet. Now, what did the stock market do? At the end of 2018, the S&P 500 dropped to 20%, and that is the actual reason caused the market crash in late 2018. So you see, the Fed balance sheet is the ultimate money pot. The pot grows, everything in it grows. The pot shrinks, everything shrinks. And on 5th January this year, the Fed meeting minutes from December is released to the public, where it mentioned that the Fed could potentially not only raise the interest rates, but also start to sell bonds in summer 2022. And this news really spooked the market, because when the Fed starts to sell bonds, it means it is sucking up the money from the market. That's why you see both bond market and stock market are selling off on that day when the report is released. The bond investors are selling bonds now because they want to sell before Fed starts to sell, right? And this pushes the bond yield up, although normally a rising bond yield is good for the stock market. But right now, the stock investors are fearful of the balance sheet shrinking. So they are also deleveraging at the same time, which causes the panic sell-off in the market on 5th January. Oof, what a mess. But what should we do now? Should we just sell everything and sit on cash to wait for a bigger crash? Well, before you overreact and start to sell everything, hear me out first. I actually don't think that we're going into a bear market just yet. Some temporary corrections, yes, like the one we are having right now. You see, the Fed's plan of sucking up the money from the market is due to the fear of high inflation. And the headline CPI data came out on Wednesday tells us that we have a year-over-year inflation reading of 7% in the US. Wow, that obviously sounds horrible. But what if the inflation is indeed transitory? I know, when I said transitory, you probably want to throw eggs at me. And indeed, no one believed the Fed when it said the inflation will be transitory. Everyone is fearful of high inflation. But my thesis is that the supply chain disruption, which has been ongoing for the entire 2021, is the biggest cause for inflation. You see, supply chain disruption causes shortage in lots of goods. For example, we have been hearing about the chip shortage for a year now. And because the goods shortage started in the beginning of 2021, while the consumer demand is still going up, retailers and manufacturers are double ordering, triple ordering to get hold of the goods, and they're also hoarding their inventories, which is the biggest factor to a rising price in goods. But what happened next is that during the second half of 2021, some of the consumer demand is satisfied. Mainly because you probably have bought a new TV, a new PlayStation, a new washing machine, or even a new car. And the need for buying another one is not until maybe after 5 years. Although the supply chain shortage is still ongoing, the inventory in some sector has already built up. That's why we see a flattening of the CPI index around July, August, and September last year. In October, the inflation went higher. I think it is mainly because most of the population had gotten double vaccines by then, and people started to feel safe and went out to consume more services. We see a higher consumption in service than goods in that month's report. In November, December, we started the Omicron variant fear, but since the holiday season is upon us, the goods consumption is going up again, which could be the cause of the steepening of CPI index. Well, we don't know that for sure, it's just my speculation. I guess we need to wait and see the CPI data for January and February when the holiday season passes. Also, on the supply chain disruption note, we don't know how long it is going to continue. Well, I don't think it will be resolved totally in 2022, but I think it is on the path of recovery. Some reports indicate that the ship clearing speed is much faster than before. If you have fallen asleep by now, my bad, but if you are still awake and listening my rumblings, here is the bottom line. I believe once the supply chain shortage is cleared and the consumer demand is stable, we could see an inflection point where CPI starts to flatten again. And it is when this happens, the Fed might reconsider their money-sucking program. Well, they might still take some money out of the system, but it might not be as aggressive as we imagined. And when that happens, the stocks could very well be on the way to the moon again. And I would not want to miss that. As a stock investor, you want to look 2 steps ahead of Fed's potential move. So I'm monitoring the CPI closely and will continue updating on this channel. So if you want to stay up to date with the CPI analysis, then consider subscribing if you haven't already. If you have those safer stocks like Amazon and Google in your portfolio, I would not sell them at the moment, but I'm not buying the dip either. Although my belief is the inflection will come, I don't know for sure when and if it is going to come. So if you have some cash on hand, then I would just wait for now. So boring, I know, but sometimes doing nothing is the best strategy. But this is not financial advice, so examine your unique situation and decide for yourself. Now let's circle back to those growth stock and cryptos. The reason I think there is still some downside is because although in my best hope scenario that the Fed will reconsider the money-sucking program when it sees an inflection point, the rate hikes are still very likely to go through. So the growth stocks and cryptos will continue to suffer the most. But I am not selling here because, to be honest, the growth stocks and cryptos have fallen so much so fast, the rate hikes news are probably already priced into now. Although it might still go down, the short-term downside is limited. Also, you see the market doesn't go down in a straight line. There will be bounces on the way down. And if you believe that we're going into a bear market, meaning we are going to enter a long-term price downtrend, then selling on the bounces will get you a better price. Now, what do I mean by bounces? Look here. During the 2008 crisis, when the initial sell-off started in late December 2007, the price went down 15% in just 3 weeks. But if you waited for a bounce to sell, then it is 4% down instead of 15%. The market is always like waves for both directions. It neither goes up in a straight line nor goes down in a straight line. You see the wave up and wave down, wave up and wave down in an uptrend, and the wave up and wave down, wave up and wave down in a downtrend. So if you believe we're entering a long-term downtrend, then a simple rule of thumb is sell on green days. That has a higher likelihood of a better price. But I don't think the growth stocks and cryptos are entering a long-term downtrend now. So I will probably take the bounce opportunity to rebalance my portfolio and wait for a better dip to buy in, because I still think the upside is unlimited for the long run. If you have cash on hand, perfect. If you don't, you could consider taking some profit on the bounce. But never sell all of your growth portfolio because no one knows what's going to happen tomorrow. And when they start to run up, they run pretty fast. And I don't want to miss on that either. So if you find this information helpful, then please smash the like button and consider subscribing if you haven't already. Like I said before, I will monitor this situation closely, so stay tuned for the new updates. Now that's it for today. I hope you all stay safe in the market.